Did you see that move? That insane spike? If you're a trader, that spike isn't a celebration. That panic has a name. FOMO. Fear of missing out. It forces you to buy high, sell low, and treat the market like a slot machine. Your problem isn't the charts, it's your brain. FOMO is purely psychological. It turns discipline into dust and strategy into wishful thinking. We need to rewire that brain. Because if you don't control your emotions, the market will control your money. You know the feeling. It's 3 a.m. Your alarm is off, but you're awake. Why? You swear you can hear the sound of money being made without you. That one coin? It just went 300% KO and you missed the entry. This isn't just a bad habit. This is the psychology of the FOMO trader. And it leads to our first, biggest problem: chronic emotional exhaustion. Let's break down the vibe killer. FOMO stands for fear of missing out. But for traders, it's basically an anxiety disorder you pay for. You enter a state of hypervigilance. Your brain is wired to constantly search for threats. In this case, the threat of not getting rich. You stop having a life. You are checking charts at the gym, at dinner, in the middle of a lecture. Every ping, every market spike releases a little shot of adrenaline and cortisol. You're always on, always ready to trade. That flood of stress hormones never stops. What's the result? Chronic emotional exhaustion. You're physically and mentally drained. And guess what tired people do? They make stupid decisions. That exhaustion bleeds into your trading. When you're running on empty, discipline goes out the window. You enter trades you know are bad just to make the anxiety stop. So how do we escape this toxic cycle? Time to put your mental health first. Trading is a marathon, not a sprint. Tip number 1, the timeout rule. Set specific windows for checking the market, say 10 minutes every 4 hours. Outside those windows, the app is gone. Tip number 2, the bed barrier. Your bedroom is for sleeping, not for stressing over red candles. The phone stays outside or on silent mode. Seriously. Tip number 3, reinvest your focus. That energy you spend scrolling, put it into a hobby. Reinvest in your real life. When your mind is relaxed, your judgment is sharper. Ever just known something was going to happen? You saw that crypto dip, you knew it was a buy signal, or you knew that stock was going to crash and you held. Then, bam, it plays out exactly like you thought, but you didn't act, or you acted wrong. And now, you're mentally kicking yourself. This isn't just a bad mood. This is the psychology of the FOMO trader, specifically self-blame and intense regret. Let's dive into why your brain does this and how to break free. So, why do we feel like absolute idiots after a missed trade, even when the future was totally uncertain before it happened? It's thanks to something called hindsight bias. Basically, once an event has happened, like a stock soaring or crashing, your brain tricks itself into believing you knew it all along. Before the pump, it was a 50-50 guess, right? But after the pump, your brain says, duh, it was obvious. This makes you feel like you messed up big time. It wasn't just bad luck, it was your fault for not seeing the obvious. You start yelling at yourself internally. These thoughts are the core of self-blame and intense regret. They erode your confidence. This constant self-criticism can lead to a vicious cycle. You feel bad, so you make impulsive trades, which often leads to more losses, more regret, and even more self-blame. It's a toxic loop that traps you. So how do we break free from being our own worst critic? This isn't about being perfect. It's about being present and rational. Tip number 1, the decision journal. Before you enter a trade or decide not to, write down why. What's your logic? What are your risks? This creates a factual record. When hindsight bias kicks in later, you can look back and say, nope, based on what I knew then, that was a rational decision. It disarms the I should have known trap. Tip number 2, practice acceptance. Trading involves uncertainty. You won't catch every move. You will make mistakes. That's part of the game. Accept it, learn, and move on. Don't dwell. Remember, your brain is trying to protect you, but sometimes it overthinks. Be kind to yourself. Ever been so focused on one thing, you completely missed everything else around you? Like trying to find one specific meme in a sea of TikToks. In trading, when the FOMO hits, your brain does something similar. All you see is that massive green candle, that one tweet, that one influencer saying, "to the moon." This isn't just ignoring details. It's a deep psychological trap for FOMO traders. Loss of objectivity and cognitive tunneling. Let's unmask how FOMO messes with your vision. Imagine your brain has these super cool high-tech lenses. When FOMO takes over, it switches you to tunnel vision mode. This is cognitive tunneling. Your focus narrows intensely on just one aspect, usually the soaring price or the hype, and filters out everything else. Why you stop seeing the overall market trends. You ignore warning signs like overbought indicators, bearish divergences, or even bad news about the project. A major exchange could be having issues. The project lead might have just sold a huge bag, or the technical analysis could be screaming, "sell," but you don't even register it. You lose your objectivity. Your ability to see the full, balanced picture disappears. It's like wearing blinders at a party and only seeing the snack table, completely missing the dance floor and your friends. This leads to incredibly risky, uninformed trades. You're making decisions based on 5% of the information, because the other 95% got blocked by your FOMO-induced blind spot. This isn't strategy. It's just pure, unadulterated hope. So how do we rip off this market blindfold? Time to break out of that tunnel and see the whole picture. Tip number 1, zoom out your perspective. Don't just stare at the 5-minute chart during a pump. Look at the daily, weekly, even monthly charts. See the bigger trend. This gives you context. Is this spike just a blip in a larger downtrend, or is it part of a legitimate breakout? Stepping back helps you see the forest, not just one tree. Tip number 2, the pre-trade checklist. Create a rule-based checklist for every trade. It forces you to objectively review multiple data points before acting. Don't let FOMO narrow your vision. The market is complex. Your analysis shouldn't be one-sided. You've just watched a massive trade go wrong. The chart is bleeding red. Your account balance is sad. And what's the first thought that screams inside your head? I need that money back, and I need it back now. That raw, primal urge isn't strategy. It's desperation. It's the worst kind of emotional trading. This is the dark side of FOMO psychology. the vicious cycle of revenge trading. It's toxic, and it's what blows up most accounts. Let's break down this deadly compulsion. Why does our brain do this? Why do we double down on the riskiest trades right after a loss? There are two powerful psychological drivers at work. The first is pure anger and ego. A loss feels like an attack. It hurts your ego, and you want to fight back against the market to prove you were right. You treat the market like an enemy you need to conquer. The second driver is the sunk cost fallacy. This is the delusion that since you've already lost money, that's the sunk cost. You should risk even more money to justify the original bad decision. You think, I can't stop now. I'm too deep in. You're not investing. You're chasing a debt the market doesn't owe you. The result? You enter trades without analysis. You use huge leverage. You take positions that are 10 times riskier than your normal plan. You're not trading to make a profit. You're trading to quiet the regret. This isn't just about losing money. It's about destroying your trading discipline and mindset. We need a hard reset. When that urge for revenge hits, you need a psychological emergency brake. Tip number 1, the 24-hour cool down. After any major loss, you are physically banned from trading for 24 hours. Delete the app. Close the chart. Go touch some grass. This prevents the immediate angry impulse. Tip number 2, the trade size reset. When you do come back, your first trade should be the smallest possible size, even $1. It trains your brain to focus on executing your strategy correctly, not on recovering a dollar amount. You trade to rebuild good habits, not to win back cash. Tip number 3, accept the loss. The money is gone. It's a fee you paid to the market for a lesson. Truly accepting the loss as a sunk cost is the only way to stop the spiral. You wouldn't throw $1,000 after a lost dollar in a street drain, so don't do it in the market. It's about controlling your mind. We exposed the deadly cycle of FOMO, the paralysis of regret, the blindness of tunnel vision, and the account-killing anger of revenge trading. Every time you trade, you're battling your own psychology, not the market.